at its core, this is a data business, and not a data business from a like iBuyer, we're going to try to make some like algorithmic decision on what we think the market's going to do, but a data business based off on how can we use the existing data to make our business better. It's almost like supply chain data or like an internal ERP approach. And at its core, like it basically begins when we acquire a home. But so the most important part in that though is the source 7 data, which is the make, model, serial number of every single piece of capital equipment in the house. Like that data is the kind of the bread and butter for everything that we do.
Welcome to Deal Flow with me, Michael Poulio, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. Each week I talk with industry insiders on everything real estate, capital, and prop tech. Today we're thrilled to have Sean O'Dowd, managing partner of Scholastic Capital, join us. Sean has carved a niche in the real estate investing realm by strategically focusing on single-family homes within top-tier school districts. Since co-founding Scholastic Capital in 2020, he's leveraged his deep knowledge from his private equity background to significantly impact the family housing market, providing value to both residents and investors alike. Under his leadership, Scholastic Capital has thrived by targeting properties that promise both quality living and robust investment returns. Sean, thank you for joining us today.
Yeah, thanks for having me. I'm excited for it.
Yeah, great. Well, I know I just gave you a little bit of a mouthful of an intro there, but I'd love to hear it from your own words. If you could just kind of give me a little bit about your background and what you're focused on today.
Yeah, for sure. I mean, very high level. I am the son of a teacher and moved a ton while growing up. I moved 22 times before I went to college. So I got into the real estate was something I was interested in kind of from the beginning because I was looking for a new home to live with the family every year. And then with my mom being a teacher, kind of noticed early on, I was like, oh, no matter where we live, there's a really good school district in that area. Everybody knows that school district. Everybody's trying to get their kids into the school district. This is kind of an interesting universal human thing. So I had the idea for a while, went to college. I was in Wharton's undergrad program, and then I worked in big consulting for a while. And then smaller consulting for a while, but most of my work was private equity focused, typically like pre-work diligence or post-deal value creation work. And during that time was basically investing on the side, my own capital under the thesis, which is Scholastic Capital now, of, hey, if you buy a really good home in a highly desirable, highly demanded school district, you've got a lot of tenant demand. And if you also are buying in areas at the same time that is supply constrained, where there's not a lot of rentals, you kind of have this really interesting supply demand characteristics where a lot of demand to be there, no rental supply available. You're basically the only game in town with the highly desirable asset, which is just about the best position you can be. So I was doing that for a while and then got to the point where left, and now it's my full-time job and it's a full-time fund that we're building out here.
Awesome. Well, thank you so much for that, Sean. So I love that thesis. I feel like, great school districts attract families that stay a long time. They're stickier. They're willing to pay more. And, everyone loves their kids. You got to get it. They're all doing it for the kids. So I guess how did you talked a little bit about how you got to this thesis based on, jumping around a lot when you were a kid. I guess, now that you've been starting to invest around this thesis, have you what kind of results have you seen? Does this prove out? Have you seen this prove out so far as investing in really great school districts leading to presumably better tenants, better buyers, higher pricing, higher rent growth? What say you regarding this thesis proving out over the last 4 or 5 years since you've been doing this?
Yeah, it's very much proven out, and it's for lack of better words performing quite well. And we are kind of straight down the fairway of like a core real estate thesis where solid yield, solid returns, and we think a very high floor. And it's been interesting. I mean, to your point, families, we most commonly see families move in when their eldest child is starting high school. And that family does not move until their youngest child finishes high school, which is in most cases 6 years down the line. So we sign multi-year leases with our tenants. Our average lease with our tenants is a touch under 3 years at initiation with annual rent escalators. Our average tenant makes around $210,000 a year. Our two most common jobs for tenants are software engineer and doctor. And they're high quality assets. Once we have families in, they're settled into the home. we typically hear maintenance requests about 3 times a year per house. So it is very decidedly high quality tenant, high quality place, able to generate yield, long-term leases. And then as a result of that, from our investors, like our investors get monthly distributions because we've got multi-year leases. We've got the cash flow stability to pay monthly. They get depreciation, and then they get the equity value of the homes as well. So we're kind of decidedly like high floor core asset.
Okay, so let's get to like some specifics around $210,000 average income, software engineers, doctors. You're talking your floor for what a good school is relatively high, right? So we're talking 9s and 10s out of 10 if you're like looking at the great score, greatschools.com or whatever. So I guess 2 questions there. How do you evaluate whether a school is good enough for your model? And then where are you finding those single family homes, right? So are you building those homes? Are you buying existing properties? Tell us a little bit about the deal flow process, that the filtering of the location and then the filtering of the asset.
For sure. So 2 different kind of components to that, to your point, like location and then asset. Location wise, there's a couple of different cuts to it. The first one is we are building the portfolio with the intention of keeping optionality open to sell it down the line to Tricon or Blackstone, which is now one of the same, Invitation, Progress, whoever it might be. Like, we're keeping that optionality open. So our board of advisors is from those places. We spent a lot of time speaking to those places, and the consistent feedback we've heard from them is, if you're going to sell us this portfolio in a decade, put it in the upper Midwest, and that's where we'd be most excited to buy it. So that's where we're buying, is we're exclusively looking in the upper Midwest and across the Minnesota, Wisconsin, Illinois,
Indiana, Canada,
Michigan. Upper Midwest? Just a touch south.
Just a touch south. So lower Canada, upper Midwest. No, I'm just kidding. Go ahead.
Well said. So across those 5 states, we've got 37 zip codes that we track and we buy in. And from why those zip codes, so that's why upper Midwest is the sale. Why those zip codes? Supply and demand characteristics. So we're looking for areas on the school district side, which is our demand driver. We do have to check the great schools because that's what integrates with Zillow. So that's what prospective tenants see. But other things that matter to us is like durability. I want a long-term good school district. I don't want one that's going to fall in the rankings. I want one that's been elite for a long time. And then our actually most predictive data set that we have is we have a data set that shows what % of high school graduates go to Harvard, Princeton, and MIT. And there's like a magic percentage in the threshold where if it's above a certain %, the graduating class going to those 3 schools, we can charge a higher premium in rent. And then on the supply side, like, we're looking for areas that owner occupancy rates are 90% or higher. Typically it's about 60-65%. So it's basically areas where everybody owns their own home, which means there's no rentals available. We're looking for areas that don't have land left, because if it's a really good school district, every single plot of land would already have a house on it. And we're also looking for areas that traditionally have not allowed multifamily development. Meaning you can't knock down a couple houses and lots in a row and build a big multifamily complex, because that would dump a lot of additional rental inventory on, and to your point, screw up our supply demand characteristics.
Okay, great. And you're saying, from a tenant or a customer perspective, they're looking at Zillow. That's how they're getting some of their information, or most of their information. You're able to obviously pull information from a variety of different sources to find more analytics around what you talked about with the higher, the MIT, elite school cutoffs. I guess are those data sources available to the general public, or is that something that you have to craft yourself or mine, or how do you find the data you need in order to do the work that you need to do?
Yeah, it's been all in was about a 1.5-year process to get to the 37 zip codes. And every data set that we use is publicly available. Like, we didn't buy any data. However, we did do a lot of cleaning, aggregating, and stitching together from publicly available data sets. For example, the IRS actually has really good data, shockingly. But you can download from the IRS by zip code the number of tax returns that were filed in that zip code. And then you can also see, out of those tax returns that were filed in that zip code, what number claimed any number of hundreds of exemptions. So for example, you can say, like, hey, for this zip code, how many tax returns were filed, and then how many tax returns claim the homeowner's exemption. like that's a pretty good proxy to say like how many people are actually living in this zip code full time. So to your point, publicly available data, but a lot of cleaning and analyzing and stitching together.
And so I assume that since you have come to this very specific criteria, you've been able to back test around what price appreciation, the gap in rent value, the rent from the non-set 37 zip codes to these 37 over a period of time. And that's what's giving you confidence that, hey, these are the right zip codes, the right metrics to be looking at.
That's right. That's exactly right. And what we've seen is these zip codes are above average price appreciators, but they're not the highest. They will never beat the like quick, fast growing, like highly gentrifying, whatever word you want to use. They're never going to beat those zip codes. They're called like decidedly like 3 out of 4s. They're like B pluses on appreciation, but their downside protection is an A plus. If you go back to 2008, 2009, our zip codes are some of the best performing zip codes in the country. Because even though the market as a whole was going down, and these zip codes sometimes were flat or a smidge down, they were some of the best in the entire country because it's the really good school district. And even if you have people leaving that area, there's always people who want to kind of move up to that highest end zip code, which is why we kind of think of our thesis as, hey, we're a pretty high floor thesis. We're never going to beat the returns of a multifamily development that hits, but like our odds of going to zero are much lower because if you back test it, it comes out quite strong.
Yeah, and people, negative, I guess, household formation, right, is based on job loss. So if you're renting to software engineers and doctors in 08, you're probably not losing any software engineers, and you're probably not losing a lot of doctors, generally speaking, right? As long as you don't have population loss in your area, you're always going to have a doctor's probably not going to lose their job pretty much no matter, unless they elected to move or something like that.
That's right.
Yeah. So you talked about your tenants signing 3-year leases. How do you get them to agree to sign a 3-year lease? I have a second part of that question, but I'm gonna stop there. How do they get comfortable with that sort of thing?
Yeah. So the fascinating thing about that was 3-year lease was not intentional. So I was doing this myself, my own money for the first couple of years before turning into a fund. And the intention was years ago, 1-year leases for tenants. The only reason we went with the multi-year lease was because just about everybody was asking for it. And the reason why is everyone's moving in when their kid is a freshman year and starting just freshman year of high school. That's by far our most common tenant. They don't want to leave until their child graduates high school. But because there's so few rentals available in these areas, they don't want to sign a 1-year lease and then risk losing their home and then not being able to find something else. They don't want to move in the middle of high school. So in our tenants' eyes, they're like, hey, can I just I'm not going to leave until they get the diploma. Can we just wrap this up? Can we do a multi-year lease? And we're like, sure, we're going to want to put annual escalators in there. They're like, fine, that sounds reasonable. And we're like, great, let's do it. So it was actually tenant driven.
Okay. Yeah. I had another question, but then your answer, I have a different question. So these annual escalators, are they fixed? Are they tied to CPI? I would imagine in these last few years, you could be, getting into trouble. Fixed was probably not a big, because that's very common in the commercial space is fixed. But if you had done fixed in the last few years, you would have come out not in a great position from a landlord's perspective. What is that? How do you guys think about that?
Yeah, so we set them as fixed, and they're typically in the neighborhood of 3 to 5%, but we round it to the nearest 100. We tried it in the past where it's like $3,781, and tenants are like, why? So we do like 3,800, but for that reason, it's never exactly perfect because it's always rounded.
Okay, and so you basically might fall a little bit behind the rent market, but then you have that opportunity in 3 years, so then you reset to market if the CPI, if rent, not necessarily CPI, but the rent component of CPI moves faster than your fixed component or your fixed escalator.
That's right, and we think the turnover is more expensive than it is often given credit for. I mean, there's the obvious costs of yeah, exactly. You gotta clean the house. You gotta get marketed. You gotta get a new tenant in there. But the other thing that's interesting too is if you like plot data regarding like maintenance requests and what that looks like when people first move in, there's a huge spike because they go through everything and they're like, this knob is a little rickety and this, that, whatever. And then once they're stable and they're stabilized, like you don't really hear from the tenants anymore because you've got a good home. We buy good homes.
Yeah.
Even if we have the home in great shape, a tenant who's already in there is going to be like, this knob's rickety, but I don't care. It's been rickety for 6 months and it's no big deal. When we have a new tenant, it's like we're sending a handyman out to go fix that. So like we think it's, even if we lose $100 top line from where we could be, the savings on the bottom line like actually nets out higher.
Sure. Yeah, no, that makes a lot of sense. I mean, just, the other question I had that I'm remembering again, is my wife and I, we are from New Jersey. We moved from New Jersey to Boulder, Colorado. We didn't want to commit to buying a home because we didn't know the area that well. So I would imagine a lot of your avatars, well, potentially are people who are in our similar situation. They're relocating. Do you guys see a lot of that sort of tenant base? Because I had that same concern where I was like, hey, I don't want to have to move across the country and then move again in 12 months. I've got kids, I've got, they're in the schools and all the things that you are looking for. Boulder's probably not a market that, all the schools are good here. It's probably not, well, certainly not in the upper Midwest. So that out for sure. We negotiated a 2-year lease initially. And then what happened was the market at that time, the pricing of homes was just like moving up so fast. They were like, let's just break our lease and buy something before we get priced out. So do you have, is relocation a big component of your tenant base at all? And if so, do you find that people are potentially transitioning from homes to the for sale market? Like I would imagine I imagine that might be part of where you see people go, right? At that point.
Yeah, we see there's like 5 archetypes of tenants that we see most commonly. The first one's about 50-60% is like kids are about to start high school. I'm going to rent. And then when my kids are out of the house, especially because we're in upper Midwest, it's like, I'm going to Florida, like empty nest there. So do the buy versus rent math. They're like, it's always cheaper to just rent. Those people are typically coming from like 20 minutes away. So not crazy. Next big archetype we see is in the middle of a divorce, where it's like somebody lives in town, they're splitting from their spouse, they want to stay in town for when the kids are with them. Next archetype is relos, to your point. Next archetype is international assignment, actually. We've got tenants who are like, hey, sent over from Europe for 3 years, don't know the area. They ask all the other VPs at the company where they should go, and they all happen to live in this town. So they're like, all right, I'm going to go rent there too. And then the last one that we see, and this is a small minority, but we have seen it probably a dozen times or so, is renovating or building, where I'm in town, I've got a big house being built, but it's not going to be ready for a year and a half, so I want to stay in town so my kids are in the same school.
Yeah. Okay, cool. And then that makes a lot of sense. So relos and stuff aren't a huge portion. You're mostly dealing with, people who are already kind of in the market or have a predetermined exit out of the market, and they're not going to just move to the for sale market. Okay. And then, let's go down to the asset level and talk about, we talked about the filtering of location. We talked a little bit about how you guys determine a tenant profile. Let's talk about the home. What is a typical house look like, price-wise, size, amenities, that sort of thing? And then, what do the rents look like typically?
So for us, average home, 3.1 beds, 2.2 baths, 1,760 square feet is the average house in the portfolio now. Average purchase price is $480,571 on those houses. And from how we're getting them, buy box, how that works is, part of it is because we want to maintain the optionality to sell. So we've spent a bunch of time getting a buy box from the bigger guys so they can just lift and shift.
Sure.
So we've got 17 different things we're screening on, like minimally 3 bedrooms, minimally 1.5 bath, like has to have a garage, no pools, no solar panels. It's got to be on a street where the speed limit is 25 miles an hour or less. If it's faster than that, it's harder to rent, and the big guys won't want to buy it from us. So how we're getting them, we've built custom software that sits on top of the MLS. So every day new homes get dumped in, it gets run through our automatic, like a 3-bed versus a 2-bed is an easy check. That's listing on every house. And we've got manual underwriting, and then we have actual numerical underwriting of like, does this thing actually cash flow and yield what we're looking for? With the objective being, we want to have everything we buy, we want it to yield at 6.75 in a base case. I have it actually up on my other screen.
And what do you say at 675? Is that, what is that? Is that gross, or is that your?
That's a unlevered yield on cost in terms of what we're shooting for is the goal. And yeah, so I have it right here. Like we've got in our zip codes right now, we've got 539 homes on the market. 178 pass our binary checks, 98 passed manual underwriting, and then we've got 8 homes out of that 539 that we think are at the base case yield what we're looking for, and then 27
at the listing price, 8 of them
at list price, and then we've got 27 where the high case hits our yield target, which means those are the ones where if you want to negotiate the price, like we think we can probably get there.
Right. Yeah. So somewhere between list and 10% off or something like that.
Exactly.
Got it. So it's about 5% of the inventory that you think you have a pretty good shot at or an excellent shot at.
Correct. Okay. Yeah. 1% is like high odds, up to 5% of like possible, depending on how much they want to negotiate.
Yeah. And is that a pretty typical, I guess I assume so that funnel also starts from the top, right? So is that 539, relative to 2 years ago, 5 years ago, is that low, high? What does inventory look like? Because that obviously is going to determine your pipeline, which is obviously going to indicate how many houses you can buy.
For sure. It's low, but it's low but normal from a seasonality perspective, partially because it's we're mid-December right now. And I mean, these zip codes, they're really school district driven. So during the summer, we've got, right now we've got 8 homes at base case. During the summer, any given day, it'll be about 100. So it's a pretty big seasonal swing in these markets.
Mm-hmm. And right, so someone's leaving in December, it's probably not for because they want to necessarily. There was some sort of distress, some sort or situation where they have to go or whatever. Especially in December,
exactly.
Holidays and the whole thing, not just the school year.
Mm-hmm.
So and I assume when you're 675, that's a nice yield going. That's a going in yield based on what you guys think you can get out of rent, and then is that kind of walk us through maybe a little bit on your operating expense assumptions. You are operating in a very small geography, so you probably know your expenses pretty darn good or well. Let's cut that out. I said good. Forget that. Don't say that. Gotta make it seem like I speak English well here, or speak English good. But so we start with revenue or your top line.
Mm-hmm.
You've got your taxes and insurance. I assume that's pretty easily pegged. But the rest of the line items, how do you guys think about those, and how do you really operate a scattered site portfolio when you think about staffing and things like that? So let's talk a little about the operational piece of it.
Yeah, so the operational piece, that's the hardest part of this, and that's the hardest part of scattered site SFR in general, like transparently, like the fact that I had done a lot of like PE, portfolio operations, value creation stuff. Like if I hadn't had that experience, it would be exceptionally difficult to be doing this. At its core, this is a data business, and not a data business from a like iBuyer. We're going to try to make some like algorithmic decision on what we think the market's going to do, but a data business based off on how can we use the existing data to make our business better. It's almost like supply chain data or like an internal ERP approach. And at its core, like it basically begins when we acquire a home, is we need to basically build a data room on each house and then maintain that through the life of the ownership. So when we buy a home, we use a company called Inspectify. They're kind of the gold standard too. It's there you go. But so the most important part in that though is the source 7 data, which is the make, model, serial number of every single piece of capital equipment in the house. Like that data is the kind of the bread and butter for everything that we do. So maintenance request comes in from tenant 123 Main Street, the furnace is out. Like when we're dispatching out, it's like, hey, okay, you're going out to fix 123 Main Street. You're going to fix the furnace. It's this furnace with this serial number. Here's the last 6 things that have gone wrong with it. This is when it was installed. Based off of that, we are highly confident this is the issue. Bring that part with it. Like, okay, great. Now our one-trip resolution rate is really high. Tenants are happy. They're putting a request. It's getting fixed. And then now we can update our data system and keep our data accurate. Because to your point, like the property tax is high because it's good school districts, but it's eminently forecastable. Insurance is fixed for a year and low in these areas. The only really kind of big swing is the maintenance. And as long as you're being sharp on the data, like your forecasting can be smart. It's like, okay, this is the average age of all my capital equipment across all my houses. Like this is a very reasonable guess of what our furnace allocation is going to be this year. Like, okay, we got to make sure we're escrowing for that reasonable furnace allocation each month, each quarter. It's a pretty forecastable business, for lack of a better way to describe it, if you have that data underlying it.
Yeah. So what systems do you use to log the SKUs and then track their useful life?
Yeah. So we use a bunch. So the like input comes from Inspectify, which is really Source 7 data. The other input is from Propify, which is the PMS software that we use to actually manage the homes. Like if something was changed, for example, we swap out an AC unit, like that data lives in Propify. And then from like a pure data lake perspective, we use Google Sheets, and then we use a new software called Oyster, which is meant to kind of be like an operating system for the house of like, this is what's going on, and then like the system of record for everything that's going on in the house.
Mm-hmm. Okay. And so then you're able to track, each piece of capital that's in the house, its age, its history, okay. And that's great. And then going back to the purchase side for a second. I guess so. From a contract services perspective, we deal mostly in apartment buildings, so we have some similar oversight, but we don't have the same scattered site problems. And we can like bulk order the same toilets and have them on site and all that, right? With single, the contract services are on the tenant, I would imagine, built into your lease. So like landscaping, snow, since you're in the Midwest, so you got snow, you got landscaping, that sort of thing. Is that all covered by the tenant, or do you cover it and then bill it back, or how do you guys deal with that sort of reoccurring services?
Yeah, so on the snow side of things, we can't do it, unfortunately. Too much risk liability, tenant slip and falls, and insurance company doesn't like it. On the landscaping, we don't do that now. We are exploring an RBP where we do offer that. We haven't made the decision to do that yet, but we are exploring it on the landscaping side. It is a highly requested item from tenants. So if there's a way that we can do it at scale and at a reasonable price for us and them, then it's something we would look into.
Yeah. It's tough. Landscaping is tough. We've always been, it's like, well, what if we insource that and we buy the trucks and we have the people and we just bounce them. Even with a non-scattered site portfolio, you still have, you got to go around and around. Then like, do you have the right, and then can they start doing snow removal in the other season? And you got to really max it out, and you got to be willing to do the capital costs up front and figure out how to make that work. But and I don't think at the end of the day, it's maybe just an improvement in service. Like I don't think you necessarily like make a lot of money from billing it out, because the tenants, they know what it costs. So it's like, well, if it costs you this and you charge twice as much just to make your normal margin, and then they're like, well, I could just go out and talk to this guy, the neighbor who can come on grass for $47, and it's like you're charging me $87. It's like. But it's like, So, but it's always like every year we're like, well, maybe it's so expensive. These landscapers are hosing us. We're getting killed. And then we look at it and it's like, well, it's not worth the squeeze ultimately. So maybe when we get even bigger. Going back to that pre-purchase, it sounds like you're primarily working on the MLS marketed deals. Do you source properties off market? And then that's going to lead into like, do you do any renovations to try to get these properties in service like at a significant level, or are you mostly looking for turnkey with like a small like potential budget just to like, turn a property? Like what's your strategy there?
Yeah, so to your point, we do mostly MLS. We do some, or about to start doing some off MLS. Great thing about these areas, the high school is very proud of where their high school graduates are going to college. So every April they publish the list of like, here's everyone and their college acceptance and where they're going. That's basically the target list of everyone who's going to be selling in that neighborhood in the next 6+ months, if that's the youngest kid. So we're about to start doing that for this upcoming year. Regarding renovations, we do what we call like strategic value add. So we aren't looking for like significant tear down type work. We'll do like the paint type turns, but because this is a school district focused thesis, like we need to basically be buying and renting during the summer. It doesn't make sense to take on construction risk because if we can't finish in the summer, then the harder to rent it. For us, when we are doing these sorts of projects, like it's a 1.5 bath house and it's got a massive half bath and we think we can throw a shower in there, like we'll do that. That's 2 weeks worth of work and it's going to give us an incremental $400 on the rent. Like we'll do that kind of thing, but we don't want to take on a larger scale renovation project.
And is that like built into your like, hey, we won't take on construction that exceeds X% of the purchase price or something like that? Or how do you guys kind of like operationalize the what is a big project?
Time.
Okay. So
it's a time focus.
Each type of project has a timeline, and if it's too long or it's the wrong time of year and you're not finished by a certain date, no good.
Exactly. Like we can do like the standard turn type stuff in 48, 72 hours. Like that's easy. If it's like, hey, we need to like move some walls and order cabinets and do something more extensive than that, it's like, okay, well now we're starting to get into more than a month, and it's like, we've got 4 prime months a year to rent these homes. Like, do we want to give up one of our prime months for that? Like, typically no.
Yeah, and your tenant base will, presumably needs to see the property before they sign a lease. You're not doing like virtual, like being able to virtualize the experience for them. They're going to need to walk through the house, make sure that it's going to work for, oh, well, Bobby's going to live in this room and Susie's going to be live in this room. They gotta live it. They gotta emotionally feel committed to it.
Exactly.
Okay. And then, tell us a little bit about like, so you talked about, okay, 539 homes turns into 8 really good ones that, are at the right list price. How many properties are you looking to buy in any given month or year or season, depending on how you look at it? What's the goal? So on the acquisition side?
Yeah. So on the acquisition side of things, we are in like what we call off season. We do very few, if any, acquisitions during fall, winter. Right now, this is just us keeping like our fingers on the pulse of the market of what's going on, staying up with the agents who are in the area. It's hard to buy and rent in these areas in these times of years. If it's a screaming deal, then like we might go for it now, but it's really hard to do this time of year. So during the summers are kind of our big window, and acquisition wise, like we're looking to get up to 500 homes by 2030. Be about $250 million portfolio, and we think that's a good stepping stone to either potentially exit the portfolio at that point, or make a decision with our LPs that we want to keep going and keep trying to build the portfolio out from there.
Okay. And in today's market, you're trying to get to a 675 kind of yield day one. Where are you trying to? And then, if you're looking, it sounds like you're very focused on the goals. So, by 2030, I'm assuming you're trying to get to a certain yield on costs on the portfolio. Do you have a sense of what you want to get to, or what you think that you'll be able to drive to at that point? Is that like a 7.5, an 8, higher?
So we do have goals on that, and the way that we think about it is on a cap. So we're the feedback that we've kind of continuously gotten from SFR brokers for selling scattered sites to the bigger guys is at this purchase price of home, like 500 homes is roughly the sweet spot, meaning it's a big enough portfolio that just about everybody would be excited about it, but it's not so big that the size and scale is beginning to deter some buyers because it's too big of a bite, like $250 million package, basically.
Mhm.
So for us, like we want to get to that size and scale, so then we've got the ability and the optionality to then kind of chop it. And for us, like we would want to be looking at it from a cap rate perspective, somewhere in the low fives, like 5.25.
Mhm.
The thing with SFR compared to multifamily is like our cap rates gyrate like way more up and down because there's less big portfolios that trade hands. So like you can call it market cap rates can move pretty dramatically. Um, so for us, when we get there, it may or may not be the right time to sell. So like we are super conservative on debt, and often cases don't use debt because we don't want to force ourselves into a 10-year balloon. Like I want to get to 250 and then sit. And if the market cap rates are 6.25 at a time, then great. We're going to sit. We're going to keep cash flow. We're going to keep distributing out to our investors.
Mhm.
If someone's going to put a 5.25 in front of us because it's 2021 again and people are throwing crazy numbers at SFR portfolios, then we'll sign that LOI.
If it's 2021 again, I think you might be selling it at 4.25.
Even better.
Better, right? Yeah.
Even
That's
better.
like another multiple right there. So yeah, I was yeah, that makes sense. So yeah, you're selling into the market, cap rate, but I would imagine like an unyielded, you're going in at 675, and I assume you expect that your revenue growth is going to exceed your expense growth, so your NOI should improve over time, and your yield on costs should be higher than a 675 by 2030. Do you have a target on that end, or is it really just you're more focused on, okay, well, if I could be at a 675 going in, the long term I can't figure out or forecast that well, I'll be okay because I know there's going to be margins of safety between the market and my going in yield.
We've got an internal model. Like I know what the numbers and forecasts look like on that. The challenge is like we don't want to promise those numbers out to investors because to your point, like it's a forecast, like it could kind of go everywhere. Like part of the reason as well is like we don't forecast a refinance at any point in our future because like I have no clue if rates are going to go up or down or what that would look like. I don't want to promise investors, hey, we're going to refinance in 3 years because like rates might be 15% and we might not be able to.
Yeah.
So like we do have a
if Powell keeps talking, I'm going to be running out of business here at this point. Like 5 years out of control, so it's killing me.
Yeah, no, totally. I'm with you. So like we do have forecast numbers. Like we do think things are going to look very strong on the unlevered yield on cost side of things. We just have less confidence in that forecast compared to the forecast of like, hey, if we buy 675 and we hold the asset, at some point in the next 15 years, there will be an opportunity to sell in the low fives.
Yeah, and you're taking advantage of the arbitrage of going from a single $400,000 house to a $250 million portfolio, and you're going to get spread just from that.
Exactly.
Doing all that work, right? Like it's hard work, and you're part of a functioning market, right? To help those other players do what they need to do, and you do your thing, which is buy them one at a time, and they buy them 500 at a time. So you should get paid for that work. You talked a little bit about debt and then cash, and so maybe talk a little bit about capital structure here. It sounds like you buy some houses in cash, and maybe others you take out some debt. What is your financing strategy? Do you have a line of credit or like some kind of facility, or do you take loans out individually? Tell us a little bit about how you capitalize these deals.
Yeah, for sure. So we, for lack of better words, found a bunch of Midwestern banks, credit unions type lenders that bought into the thesis of like, hey, if we buy a really good home in a really good school district, like we're going to find a tenant who's going to pay a good price, and it's probably one of the most liquid real estate assets you can imagine because like it's a home in a good school district. So those lenders have kind of given us some really, for lack of better words, like awesome terms. Like we exclusively use 30-year fixed debt on the portfolio. We don't use anything shorter than that. And we've got a whole variety of different, like a menu of options. We can do individual, we can do cross-collateralized. We do have lines if we want to use lines. So it's really kind of market dependent on what we use. Right now in the portfolio, it's 59% LTV. Weighted average interest rate is 6.15%. And that's on the 30-year fixed. If rates are above the point where we're yielding, where it would be a negative leverage situation, like we would just buy it in cash and keep it in cash until it made sense to not be in cash. But the other element to it as well is like going back to like what we are and what we're trying to be. The vast majority of our LPs are using us as their like conservative slug in their alternative investment portfolio. They've got like $1 million in a like multifamily reposition that's going to triple their money or go to zero, and then they got $1 million in us, and we're their like steady Eddie like AT&T stock dividend type play. So we don't want to really lever up too aggressively because it's not in the spirit of what our LPs are looking for. And I also just think SFR is not a good asset class for a high amount of aggressive leverage as well. Like you don't have the ability to pull off a play that you would in say multifamily, where like high leverage can actually make sense to do.
Yeah, I would. I don't know if high leverage necessarily makes sense in multifamily either. I mean, I guess it does during some parts of the market if you get in and out of the right spots. I think a lot of people are realizing the hard way that was, high leverage and short-term bet can hurt you.
Agreed.
Right now.
Agreed. I agreed.
So I think staying at it 60%, is that loan to cost, loan to value? I guess, are you reevaluating your portfolio on an annual basis and coming up with that?
Yeah. It's loan to value. We because we are a true fund model, so our fund admin accounting firm does need to restrict NAV. So that's based off of quarterly. We use a valuation company. It's quarterly revaluations that the accounting firm then values.
Got it. Okay. So based on your in-place debt costs and your going in cap rates, you're yielding, 3 to 6%, something like that in cash, or like what kind of yield are you typically able to provide?
Yeah, it's between 5 to 6% for investors. It bounces pretty a lot actually because we pay it monthly. So like 1 month is 5.1, and then the next month is 5.8, and then the month after is 5.3. But it's always kind of within that 5 to 6% band. And then we do pass depreciation on the K1. So that is for most of our investors, it's 5 to 6% tax free, or like you can think of it as like an 8 to 9 pre-tax.
Mm-hmm. And you're not, you're just doing a straight line depreciation, 27.5 years, or are you able to accelerate? Are you doing accelerations and cost segregation on your, 5-year useful life stuff, or what does it look like?
We are doing cost segs. So we're pulling cost segs on all the properties, and we can accelerate a pretty decent amount, which with current tax law, we expect our investors shouldn't have any tax liability for the first 7 years of distributions. TBD on what happens with the new administration and tax law and all that good stuff.
Yeah, I would imagine it would only be at least no worse than it is today. But we'll see. We'll see what happens. We'll keep our fingers crossed. So you talked about how in the non-acquisition season, right, which is kind of the season you're in now, you're really trying to just keep a pulse on the market. What does that look like for you guys? How do you guys prepare for the next buy time, right? Like, because then you have a very tight window to buy all the houses you're going to get for the next year, and lease all the houses you're going to get for the next year. And I assume it's that's a pretty stressful time. That's like your playoffs and your versus this is like the season. So how do you keep a pulse in the market? How do you prepare for that time when you're going to have to buy and lease?
Yeah, it's a variety of there's a variety of different things. So there's like market, there's operations, there's hiring, there's fundraising. Basically, is what we do. On the market side, we're in our in-house software tool that we built every day of like looking at the markets and getting a good pulse of what's available, what would we buy if we were buying, what do we think it's going to close at, and then retroactively, what does it close at, to make sure that we got a great pulse on it. If we think the house is worth 455 and it closes for 450, like, okay, you think it's worth 455 and it closes at 490, like, we need to get our pulse right. The other thing that's fun is because we only buy in 37 zip codes, and each zip code has like 2 agents that control like 80% of the volume. It's like 75 agents. So we can build profiles of those agents, and it's so fun because the agents are very predictable. Like, hey, like this agent always does this, or this agent always overprices this, but underprices that. Like, we can get sharp on it. So that's one. Operationally, to your point, like that's playoffs. So for us, like we spend a lot of time right now building and refining ops of like what worked, what could be going better, how can we be faster, more efficient, make sure we're storing all the data the right way, getting it to the right people. Like there's a lot of kind of tweaks on the margins on the upside. Hiring, this is the time of year for us to be bringing in new folks to the team. We don't want to bring people in the middle of the summer because it's a disservice to both us and them to be trying to ramp them up while we're in playoff time. So this is hiring time for us. And then fundraising. We're an evergreen fund. So all of our investors, all of our net new investors who are joining us are joining to the existing portfolio. It's kind of like a private REIT at this point. So like they're buying into an existing portfolio, which is great. But like we don't really have the time to be fundraising and speaking with prospective investors during the fall, or excuse me, during the summer. So like this is our time to get to know people and people get to know us and see if it makes sense to work together.
Mm-hmm. Yeah. And, you talked a little about team, bringing team members on. What does your team look like today? Where do you find the most struggles maybe in hiring or staff?
Yeah, so our team right now, we've got 3 full-time, and then our board is 6, and they're pretty involved. So somewhere between 3 and 9, I guess, is what I would call our true head count. Biggest strugglings on hiring.
Or just people generally, just like the, people problems. What are your biggest people problems? If you have any, maybe you figured it out.
We definitely haven't figured it out. We are, as you can tell, we're very metric focused. So like all of us have metrics. Those metrics are reported daily. We have what we call the scorecard. It pulls in everybody's metrics from all our different software systems into one thing, and then it's sent to the Slack channel every day at 9 a.m. and it's either red, yellow, or green for everybody's metrics. So it's pretty easy to see like where we're doing well and where we're not, and it makes it. I mean, everybody's got 3 things at most that they're accountable for. Some of us only have 1, some of us have 3. So it makes it easy to say like, hey, like you're hitting or you're not, and if you're not, how can we help you get there? And if you're consistently not, then maybe this isn't the right fit for you and for us, and builds accountability. So like that in its core has been kind of like the most valuable thing that we've done from a people perspective. It's not for everybody, but we found that the people it is for are like just awesome people.
And are you using like EOS or 40X or something like that to operate?
We use EOS.
Okay. Yeah, we use EOS and as well. So very familiar with the metrics and the scorecards and the rocks and the whole setup. So yeah, very it takes a little while to get traction with that, for lack of a better term, but no plugging Gino, I guess, on this, but I guess I just did, but highly recommend it. So yeah, definitely takes a little while, but once you get it going and you can get it all done and have all the functional teams making sense of it and driving and they see the effect that it has, that, actually metrics do lead to rock completion and all of that. So really good. You had talked about, the supply of homes, but your customers are your tenants. So, we didn't really talk about yet how you attract tenants. I assume, it's very, there's supply constrained. You've got, you got water in the desert, right? So you're, not a hard sell. But I guess maybe talk a little bit about how you attract and find and qualify and place tenants. And then the second part of that question would be, do you develop a tenant pool in advance of inventory potentially? Like, and is that possible so that, you can better, you already like, hey, I already have 20 people who want a house like this in the area, and I'm always buying the same thing. So in the same way that you're thinking about your back end exit on the portfolio, could you just kind of build a list, your wait list, and then they just know, hey, I want to rent from these guys. And so whenever you have a piece of inventory, it's ready to go day one.
It's possible. We haven't done a ton of work on that. We honestly probably should. I was on a Chicago, like local ABC News, whatever, like a couple years ago for an interview about us. And like, I got like 150 emails from people like within an hour after it airing of like, hey, like, would love to try to get into a good school district for my kid. Like, where can I find your homes? And we literally didn't have anything available at the time because we were 100% occupied. So we absolutely could do stuff. We honestly just haven't built it out. But to your point, like, it's also been like kind of water in the desert. We haven't really needed to, so that's why it's just kind of fallen down the rock list, for lack of a better way to describe it.
Sure.
It's definitely something that we can do. What we are doing, because it kind of goes into our underwriting as well, is and our rental pricing, is we are very avid users of Zillow. And what I mean by that is over 50% of SFR is rented via Zillow. And what Zillow has is the number of days, it shows metrics for every home, like number of days the home's been on the market, number of contacts, meaning the number of times somebody's clicked, like, I'm interested, and then the number of applications. And we are, for lack of better words, scraping all of that every single day for every home in all of our zip codes. And it's really useful data because we can say, hey, like, in this zip code, there's been 60 people who've reached out for homes in the last week. Like, there's a lot of people looking right now in our zip code. And then it's also really useful from a pricing perspective. It's like, hey, if there's two homes in town and one's been reached out on 60 times and one's been reached out 10 times, like, the 61 is underpriced and the 10 one is overpriced. It's like, okay, we can kind of use that to kind of get in the middle. But other than that, like, yeah, we're basically listing the homes on the public market. They rent pretty quickly with the demand coming in. And honestly, the big things that we just need to be careful about are correctly underwriting tenants. For example, and I've got one of our advisors actually made this comment to us, like, if he sees a tenant with an applying saying they work at Google, he's like, I know it's a fake pay stub because none of my tenants work at Google. Like, we actually have tenants who work at Google. So it's difficult because, like, the fake pay stubs that you can buy online, that prospective tenants buy online, like, say Google or Goldman Sachs or things like that, because they're like trying to like make it look like they can very easily afford the apartment. Like, our tenants actually can. So, like, we have to be very sharp to make sure it actually is a real pay stub and not a fake pay stub. And there's a bunch of software we use to do that, but it's kind of an interesting challenge just by nature of the kind of people who are renting the homes.
Yeah. So we're getting here to the a little bit of the end of the session here. I have one more question maybe on that exact point. Have you had to deal with a lot of, you're in the affordable space, or even like just the Class B space, the fraud, the buying of pay stubs, and even like fake social security numbers, and just the whole setup, even like someone on the back end answering the phone and like verifying employment. Like, it's a pretty, and you could for $99, right? Like, get the whole setup. And we've seen, no matter what type of software that we use, no matter what system we use, it's, they're always trying to stay, these scammers are staying one step ahead, or we're at least lockstep with them. You have a different tenant profile. You have a different type of tenant that's probably trying to come into your school district. Maybe you have less concerns there, but yeah, maybe, have you had to deal with any significant amount of fraud or that sort of a thing? Or are you typically able to kind of weed out those types of applications?
We've seen it a couple times on applications. So we've got kind of like those like true positives. I don't know if we have had like a false positive or where we've like let somebody in and it was fraud. We've never had to evict anybody, so maybe not. But to your point, like, there's different softwares out there. Like, the one that we use, we like a lot, and it's worked pretty well for us. And the reason we like it is it connects to the tenant's bank account. So we can't actually see the tenant's bank account, but it connects in, and it says like, okay, tenant says they work at Google. The software connects to their bank account and says it is actually Google's ADP account that is depositing money into their paycheck for their paycheck each month. And it's like, tenant said they make 20 grand a month. Like, they are in fact getting 10 grand every 2 weeks from Google into their bank account. Like, that alone has been pretty strong, and we have yet to see a way to fake that. I'm sure somebody probably at some point will figure out a way to do so, but to date, we haven't come across that issue.
What, you mind plugging that software?
Yeah, let me. Yes, I actually don't know if they've publicly launched it yet.
Okay. We'll
I will see.
If you see it and then you think of it later, or it's shareable, we'll put it in the show notes, because I think I think that is the missing link. Being able to not just produce pay stubs, not just go to the employer, but go through the software processing or the paycheck processing piece and really verifying on the other side. Because like a phone call could be a random person, right? Like verifying employment. But if you can verify the cash back to the source, then that's pretty good, right?
Yeah.
I guess people could create, one bank account, right? And then, I'm sure there's some way to game the system, but does someone really, there's a lot of low-hanging fruit right out there. So do you really want to go after, those pieces? So that was great, Sean. I appreciate your time with us. It was, you shared some great insights and knowledge in the real estate space and in the, the single-family scattered site space. If listeners wanted to get in touch with you and find out more about you or your firm, or your fund, what's the best way to get in touch?
Yeah, for sure. So we are Scholastic Capital, scholasticcapital.com. I'm also very active on Twitter, LinkedIn, kind of sharing just like what we're seeing on a day-to-day basis. Probably the best is we actually have a monthly newsletter. So we send out our investor reporting every month. We send out about 2 or 3 weeks later a very similar email publicly. A lot of the data is redacted, some information is not included, but we found people really like following along because they can get to see kind of the picture of what's going on behind the scenes and what our investors get.
Awesome. Well, great. Well, thank you for tuning into this episode of Deal Flow. Don't forget to give the podcast a follow on Apple Music or Spotify and subscribe on YouTube so you don't miss an episode. And if you feel like someone else would get something out of the show, please go ahead and send it across. And feel free to comment below with regards to future guests you'd like to see on the show or get in touch if you think your knowledge and expertise would make for a great episode. Thanks again from me, and I'll see you next time on Deal Flow.
Thank you for listening to Deal Flow with me, Michael Poulio. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.